The stock market has been absolutely flying in recent months, and we've seen the major indexes smash through previous all-time highs, including the S&P 500 that has now broken the 5,000 barrier. In particular, we have seen euphoric levels of optimism across the market in the tech sector, namely in AI stocks, semiconductor stocks, as well as several mega caps from big tech too. These sorts of stock price increases are fairly unprecedented and often unsustainable, and it's starting to look like fundamentals are nowhere near where they need to be to justify stock valuations right now. This is especially the case in the context of the overall economy being in a complete mess right now, with many consumers being squeezed to the limit through a cost of living crisis, government debt increasing exponentially, as well as many reliable indicators for economic health screaming that a recession is imminent. The forward PE ratio of the S&P 500 is currently 20.5, which is pushing close to the highs that we saw in 2020 and 2021, shortly before there was a big correction that saw the S&P 500 fall by 25%. If you exclude this period of time though, which had been largely pumped up by the pandemic craziness with mass money printing and stimulus checks, you'd have to go back as far as the dot-com bubble to find a time where the forward PE ratio for the S&P 500 was this high. Now, this historic average of the S&P 500 forward PE ratio in recent decades has been in the 14 to 16 region approximately, which suggests that we are currently overvalued by a decent margin. Now, this is largely being driven by mega-cap stocks surging in price, vastly outperforming the rest of the market over the last few years. However, fundamentals have not kept up with these surge in valuations, and because of this, we are seeing the forward PE ratio of these mega-cap stocks expand much more compared to mid and small-cap stocks. Now, the last time that we saw this level of divergence between the large cap stocks and both the mid and the small cap stocks was once again during the dot-com bubble, in which we ultimately saw large cap stocks drastically correct lower to be pretty much in line with the others. Many individual stocks, particularly those in the AI sector like Nvidia, have seen some insane run-ups that are now starting to mirror some of the biggest bubble stocks that were seen during the dot-com bubble like Cisco. However, while retail investors and hedge funds pile into these stocks, insiders are doing the complete opposite. We have been seeing a large volume of stock sales from insiders, and in fact the corporate insider transaction ratio has reached strong bearish territory. Now, Jeff Bezos is just one example of a high-profile insider who is selling, offloading over $8 billion worth of shares throughout just the month of February alone. Until now, Bezos hadn't sold any Amazon shares since November of 2021, and even then the monetary value of the shares he was selling wasn't close at all to the recent $8 billion in such a short space of time. Now, Mark Zuckerberg has also recently started selling tens of millions of dollars worth of Meta stock every single day, something that he has not done since 2021 as well. Now, this is very similar timing to Bezos, and there's clear reasons why both of these individuals are selling large quantities of their respective stocks at the moment, and why they were also selling in 2021 as well. It's clear that they believe that valuations have gotten very high to the point where they could easily be considered overvalued. And both of these people were spot on when they did this back in 2021, as Amazon stock fell by over 50% between the peak in 2021 and the low seen in January of 2023, while Meta stock fell by a whopping 76% between September 2021 and November of 2022. And it's not even just the tech sector that is seeing prominent figures making large sales, as we have also seen the CEO of JP Morgan, Jamie Dimon, sell $150 million worth of his stock. This is the first time in history that Jamie Dimon has sold any JP Morgan stock, making this a fairly significant event and a signal of where he believes things are heading in the future as well. Now, one of the things that may be in consideration for these individuals selling, aside from the already lofty valuations, is the impending inflation boom that could be about to happen, which could rock the economy and the entire stock market. Inflation has been fairly stubborn in recent months, with CPI failing to break below the 3% barrier for year-on-year increases, a significant margin off of the central bank's 2% target. And what's worse is the latest readings have been above expectations, with the data for January coming in at 3.1% compared to the expected 2.9%. Now, CPI is a lagging data metric, and when you look at some of the economic indicators that lead CPI by several months to a year in time, there are certainly signs that inflation will start to spike back up. One of these leading indicators is the Global Supply Chain Pressure Index, which has surged in recent months due to the heightened global conflict and the surging shipping and freight costs, which of course leads to higher costs for businesses and therefore higher prices for consumers. Many economists already believe that because of this stagnant inflation, we are not going to see any rate cuts for at least another few months, and then if inflation does indeed actually end up spiking upwards, then this could push back any rate cuts even further into the future. Interest rates not getting cut and remaining at these current high levels for even longer is generally not a good thing for economic growth, corporate performance, and stock prices. And this is especially the case for any companies that are saddled with debt at the moment or are not actually profitable and rely on borrowing money to continue their day-to-day operations. One of the main catalysts for the recent stock market run-up that we have seen over the last several months, basically since October of 2023, was investors thinking that the Fed was about to pivot. Many people had been expecting inflation to just keep going down to 2% and for interest rates to start getting cut rapidly. However, as we've discussed, this no longer looks to be the case as the inflation data has not continued downwards and is now looking like it is making a turn for the worse, but the problem is that the stock market does not seem to have adjusted for this at all. And there are a myriad of other reasons why corporations in America could soon be hit with worsening performance which will impact stock prices. The government has a major spending problem and debt is surging at a record-breaking pace, meaning that interest payments on that debt are rising and the budget deficit is worsening. The Congressional Budget Office recently came out with an updated budget and economic outlook for the US, and they predict that these problems are only going to get worse over time. This raises concern about how exactly the US government is going to get out of this never-ending debt spiral, and one of these ways could be to increase taxation. Higher taxation on corporate profits would of course be bad, as profitable companies will be keeping less of their profit, but also higher tax on consumers would also negatively impact corporations, as consumers would have less spending power to buy goods and services. Consumer spending power is weakening enough as it is, thanks to the cost of living crisis many US citizens have been hit by. Wages have not kept pace with inflation over the last few years, but meanwhile the cost of shelter has also rocketed. Average rents have steadily increased, while mortgage rates have surged with interest rates to now being higher than the peak of the global financial crisis. Combine this with astronomical home prices, and we have a housing payment to income ratio that is way higher than historical averages, and is also similar to the peak that we saw in the GFC. The personal savings rate in the US has dropped to historic lows, and it seems that many consumers are turning to credit cards to keep funding their lifestyle, as we can see a big spike in total credit card debt. Now this is very problematic because average interest rates on credit card debt are much higher now compared to a few years ago, meaning that the longer their interest rates remain this high, the more consumers that get financially crippled, the more it impacts on corporations who rely on selling these consumers goods and services, and this will impact stock prices. However, despite all of this data and information to suggest that the stock market could be overvalued and could crash soon, there are some arguments that can be made for why this may not actually be the case. As mentioned, not all stocks are overvalued right now, and a small minority of stocks are responsible for the vast majority of gains in the major indexes. The stocks that have surged and could therefore be considered overvalued are for the most part heavily invested in the AI space and have made strong breakthroughs and developments in this area. AI is clearly a very transformative technology, and some people even argue that AI will be completely game-changing for the world that we live in and is the most significant technological development that we have seen since the internet. If AI does allow companies to exponentially grow their profit, which spurs on the global economy to grow at a faster pace, then the companies at the forefront of AI, like Nvidia, Microsoft and Meta to name a few, who also are considered overvalued at the moment by many people, could actually very possibly continue to see amazing stock price growth in the future. The macroeconomic environment is getting worse and worse by the month, and there are now a number of major institutions who are predicting complete economic collapse to come in the future. I cover this topic in more detail in my previous video, which you can check out by clicking on screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot. And thanks a lot for watching.